Okay, hello. This is number two. Oh, I just had to set my timer on my phone. Okay. Uh, the idea of the second part and the first part of the videos was something simple. I'm not gonna. I watched the other one and I waved my hands and I said some stuff a little bit wrong. I'm sorry. I said like return on invest, whatever, something. I used investment instead of invested capital. I talked about. I meant to say return on investment and not cost of capital at one point. Okay, I'm going to continue just with a very brief overview. Some of these chapters, as you can see, they're not finished. And as I try to finish and get these chapters in a reasonable kind of state, I'll make a video on them. I am going to post this book uh, uh, on my website and a whole bunch of different places. I'll put it on the home page, even I'll put it on a couple of the first pages. It should be very, very easy to find. What I'm really interested in is I respect a lot of you've been sending me emails over the years, and it's really absolutely wonderful. If you have negative comments, I'd love to hear them, or if you tell me to go in different directions, I'd love to hear them, or even if you have even a tiny bit of okay stuff, then I can actually try to get this damn thing published. Okay, that's my idea. Now, when I'm going to go backwards a little bit, not forwards. When I had things like, well, we got to be creative when we do a little bit of this stuff instead of just start apply a stupid bureaucratic formula. That's a big theme. When I go through things like this, I'm going to describe in the videos, just so you understand, this is the terminal value and different terminal value formulas that can work and will reflect the fact that you have to make capex to sustain, replace the old assets, and you have to make capex that are consistent with the return on investment and growth. That's the whole idea. If you don't do this, your terminal value is a lot of rubbish. All right? Oh, God, I shouldn't be scratching my head. I'm going to go through these kind of points. Why, this is a fraud graph, but okay. And discuss the models, but I'm not going to go through any Excel. I'm not going to do the Excel. So I'm going to talk about how we make a little simulation model of the EV to EBITDA ratio, or whatever, work through the models of this, or show you. I'm going to show you these tools I've made over the years to press a button and get some IRRs, and instead of just getting putting the stock prices on your phone, which everybody can do, is actually going through and doing a little more careful analysis where you can look at different time periods, IRRs, volatilities, real versus nominal change, their currencies, look really carefully at long-term kind of studies. Okay, we'll go through, and then what I'm going to do, what I'm trying to say, if I can get this out of my mouth, is that step one will be going through the model, the book in detail and seeing what you think of it. Step two, sometime much later, will be how do you actually mechanically work through some of the Excel stuff, reading from the internet, making the pictures, making a little bit of creative kind of models. So I went backwards then. Okay, so let's continue. There's Beethoven, and we'll talk about different case studies and different creative ways to look at this philosophical idea of the terminal value. How long will management be able to earn monopoly profits? Can you really be like Beethoven, where your stuff is still used 200? When did he die? In 18 whatever it is, 20s, 30s? Well, I don't know. Okay, so now let's go to chapter 9. I'm going to just continue with our little pictures. A couple of things now for these. There's a little bit more roughness here because I didn't, and I'm still working on the chapters. And the idea is just like if you're deciding, oh, should I go to medical school? Okay, what's the probability of me making it through? What's the probability of me making it to the first stage? That's the kind of decision rule you'd make. And then if you're a doctor later on, you'd say, should I change my job? Should I retire? Those decisions are totally different. The modeling, the thought process is totally different. And that's the same as a valuation of just about any investment. Not just project finance. This is a little more to do with project finance over the life of the investment. So I talk about Macron, okay, and his France, it's a startup nation, okay? Is it really how do we value a startup business versus a mature business? And we'll travel through time and understand, I've already kind of shown you this a little bit, that the value goes down. But if the risk goes down over time, then the value can go up when you've started to demonstrate what the risks is going down. And that's what my whole keep calm and carry on was all about. I'm using my hands too much. Shoot. Okay. And how do we value an asset over time? But then we go to the hard part, which is how do you value the early stages, the stages where there's a gigantic chance of a failure. And how should you capitalize the cost of other failures? There are so many different issues, and I really racked my brain about this. I'm convinced that having development fees is the right thing to do. I'm convinced that you should be allowed to capitalize these premiums during the development period, and then how, on an economic basis, do we incorporate this into the value? That's what I'm going through, and I'm here. Once you've made it through the development period, what's your IRR that you can realize, even if you don't sell? What's the IRR that you can theoretically realize if you sell your asset at different points? Now, this is project finance, and you might think, what are you mixing up project finance and corporate finance? What kind of shit is that? No, I'm not. I'm saying any corporation, even McDonald's, they have to decide to put a new store in some place where a bunch of people will sit in their cars with their car turned on and go through the drive-thrus and all that. Where should we locate our store? There's risks in the development in the early stages, and then once you have it's boring, the risks are totally different. And any corporation is just a portfolio of assets. And that's the problem I have with the accountants and the McKinsey ROIC, is that we want that true rate of return. We want to dig deeper. Of course, you can't. We don't have the right information to do that for a corporation, but we should understand that that's what you're looking for. Okay, and then whatever, I've got some other stuff, but then I go through in project finance, you have these upsides from refinancing. Basically, the upsides all derive from the risk coming down. Now, you don't have to sell, you don't have to refinance, but you can. And when you think about the upsides you can get, it's almost like these investments are almost like a convertible bond kind of a structure where you have I'm using my hands too much. Where you have a base case that you don't have to do anything, or downside, but you can, if you want, sell assets, refinance assets, use developments, sell portions of assets. You can do all sorts of things to enhance the upside versus the downside. These people, when you have this CFA, I forgot to moan about them, it says, debt is always riskier than equity. What a lot of crap. Everybody should know that that's ridiculous. Debt's got an unlimited downside almost, well up to the size of the debt, no upside other than earning the credit spread. Equity has all sorts of upsides. You've got to really get a little deeper in these things, okay? And there's some upsides. And then I go to project finance, and this is like a prelude, a prelude to the cost of capital, okay? And these ridiculous definitions of, I can't read this. Project finance as an economically separable capital investment in which the providers of funds look primarily to the cash flow of the project, blah, blah, blah. Here's what project finance really is. It's where lenders, bankers, ridiculously carefully structure the debt around the risks of the project and around the patterns of cash flow. So you could have a refinery project where the debt structure will have all sorts of deferrals, sweeps. It will be maybe a short structure. It will affect the volatility of refining margins. Whereas for a solar project, you're going to have a loan that reflects the seasonality of solar and the much more limited risks and limited volatility of solar, blah, blah, blah. You can go through all sorts of things, but the bankers are doing a really good job in defining the risk. That's the point. That's the real definition, and that's why it's so exciting. And that's why I find it ridiculous. I looked at the curriculum because I had whatever, I'm not going to go through that. I better not. I'll get in trouble. But I got the chance to really follow an MBA program and saw what they do. So I have to criticize that as well. That's easy. The kind of case studies they use. They didn't have any project finance. It was a very good program. No project finance classes. Can you believe that? That's where it should start. And then we talk about the DSCR and my definition of the DSCR and my story about the DSCR when you have to go meet your boss in New York and you've never been to New York and you use Google to make your forecast, Google Maps to make your forecast, and how much extra time do you leave to make sure you're not going to be late or you're not going to be late for a flight? That's real risk. That's DSCR, LLCR, PLCR. That's the real risk. And then you take all of those structuring elements and put equity, not a return on invested capital, you put the equity return that you need, and the banks have adjusted the risk for you, and it's so interesting. I go through some Monte Carlo simulation, not because I believe that Monte Carlo simulation can be useful in practice, but it can be useful in explaining things and understanding mean reversion and the risks associated with mean reversion, things like, oil prices, weather going up and down. I know we have global warming, but things that revert versus things that go out of fashion, things that get obsolete. That's the real risk. And project finance explicitly does this, okay? And then, okay, enough. Then we go, waving my hands again. We go to the cost of capital. And as you can see, an enormous theme in this whole analysis is I go through stories, and one of the stories I have is a friend of mine who took a class from me years ago, and he was somebody kind of opposite an academic. And he said, look, I got to do real work for my CFO who's ass. He might not have said, well, yeah, he did. And they want metrics that don't rely on the cost of capital. That's the real world. And Damodaran, or whatever his name is, they start with cost of capital, betas, and then have you, it's ridiculous. Okay? The real world, we want to get away from it. But let's talk about why it's such crap. And I have a 1970s article written by some man who probably was well known at the time, Marshall Bloom, who came up with this business of mean reverting betas. Okay, it sounds all fancy, but what they did, and this is just a perfect example of what's wrong with this stuff, what they did is, where's my little formula? It's right here. Adjusted beta, mean reversion. Okay, let's put 0.33 in addition. 1 times 0.33, I think that's 0.33. Multiply the raw beta by 0.67. And then when you look at Yahoo betas, you can see they're much, much higher than the market watch betas. And Value Line does the same thing, and we get a completely different beta based on this mean reversion. And when you plop it out, which one should you use? I shake when I think about this. Really. Okay. Now, these days, it would be so easy to take real data. That's why financial modelers, know how to do this. You plop some the stock prices, the Yahoo data into a spreadsheet, and you can see if there's any mean reversion. Yeah. All these studies, but the fact that they still use this 1970s paper is just a classic. Okay, and the basic problem is you can't see the cost of capital, and then I have some estimates in solar and wind projects of what kind of returns people really wanted, and you can start to get a sense of what the cost of capital is maybe from this kind of stuff. Then we go through just some general things. And again, this is why I said, okay, let's get the ability to get this stuff. You can download from Fred the corporate profits, nominal corporate profits, compare that growth to the risk, and you can see that the market's gone up because of capital gains, basically. It's gone up because we value the profits more highly. You can see that this went up and then it leveled, whatever. You can do that kind of stuff and really try to get behind this big problem with CAPM, which is the equity market risk premium, which again, the academics plop something out of this. Or you get the worst thing, which is these idiotic surveys of the CFO survey. Well, the CFO is going to overstate everything because they're going to that's where I put the biases. They want a high return, obviously. Okay, and then we talk about how basically the problem is the inputs, the problems with the inputs. And here's again, we'll go through how to get this from Fred and present it, but this is just the long-term history of 10-year, I guess, is that 10-year and 6-month treasuries. And it's always come down until now, okay? All right, but if it's always come down, the stock prices have gone up, not because of earnings, but because of that. And then we can look at kind of different ways, get real about the equity market risk premium, and how can you possibly assume that the equity market risk premium is always going to be a lot higher than the overall growth rate or the real growth rate. I'm running into problems, 2 minutes left. Okay, good. And so more on the cost of capital, and then I go through betas and what the real world estimate of betas, and I have to go back here. The real alternative to getting the cost of capital is to know that the cash flow, I'm getting nervous now because I'm running out into my limit. The cash flow, if you could get an estimate of the cash flow, which is really difficult, okay, but so is the CAPM, you can back into the cost. You have the stock price, the cash flow, you back into the cost of capital. That's easy to do. I don't have to say much. And what I do is illustrate that if you have some stable companies and they're earning kind of the same kind of returns, okay, we've got problems with returns, we don't know that. But you can select companies that are earning a price to book ratio of about 1. When the price to book ratio of 1, it's easy to show, which we'll do, that the return is equal to the cost of capital. And you just kind of fish around now, and you can do that fishing around and see what's a much more realistic estimate of the cost of capital. Here's some regressions, blah, blah, blah. Finally, stealing money from people who live in developing countries, otherwise known as the country risk premium. Is it really true that drinking beer in Nigeria or eating chocolate in Nigeria is riskier than drinking beer in Germany or eating chocolate in Switzerland? And we can get some data. And the Davenport problems, I'm going to really kind of write this up and do a little bit of a study. You can take there's Pakistan, Nestle, Pakistan, Nestle, Nigeria. You can take all these companies, look and try to decipher the cost of capital out from there. Oh, it's gonna give it me, but that's okay. And then finally, a little bit of a section on the debt and mean reversions and some of my other favorite subjects. And that's the introduction to the book. Okay, I've got some other stuff there. Okay, and that's going to be on I'm going to put that on the website. I'll keep putting new versions on and keep spouting this. Maybe nobody will watch these videos, but whatever, I'll keep making them. All right, that's enough. Let me stop this.